if you look at global markets over the last few years, there's been a couple of standout strong performers and a couple of areas that have notably lagged. And I think that's where I think you'd agree that you've got to focus some attention of your clients. So one of the key ones, and we are value managers, so we're certainly talking our own book here, but if you look over the trailing 10 years, almost all of that is now post-GFC time, but you can see just the extent to which, somewhat unusually, value has underperformed through that time. We think a combination of the most severe global recession since the Great Depression, along with central banks' QE really influencing interest rates, has combined to make it a really tough time for value. So you can see over the last 10 years, values lagged growth investing by about 2% per annum. So it's a pretty stiff headwind for us. We think there are reasons to think that this is going to turn around going forward. The broad strength of the global economy, along with, as was mentioned before, we are starting to move away from QE. The ECB overnight announcing they were going to halve their purchases from early next year. So value, we think, is where you do have some opportunity. The other one is actually in global markets outside the US. Everyone focuses on the US. It is the headlines you hear first thing when you wake up, when you listen to the radio. But if you look here, going back since June 2009, so this wasn't the absolute market low, it's 3 months after the absolute market low. That first 3 months, all the markets really rebounded pretty strongly, but you can see in the 8 years since that point, it's really been the US market going from strength to strength, earnings obviously driving that, earnings hitting new highs, the market hitting new highs, but that market substantially outperforming the rest of the global markets. We've got Europe, we've got Japan, emerging markets, and all on this slide. And while they've done okay, and this is in US dollar terms, so that's a factor, you can see while they've done okay, they've clearly substantially lagged the US. But with the breadth of economic and therefore earnings recovery that we see coming through over coming times, we really do think it's the lagging markets outside the US that represent much better value. Now, I'll come onto the portfolio in a moment, so you've got to caveat that with the MSCI global indices generally have about 55+% in the US. So the average global equity fund has more than half their money invested in the US. So while we do find a lot of opportunities in the US, it is the single biggest country exposure. It's dramatically underweight exposure for our portfolio. We're not at 40% because we want to be close to the index or anything. We're genuinely finding a number of opportunities, even in that market that's done really well, but it is significantly overweight. But as you can see here, the portfolio basically 40% US, 40% Europe, and 20% in Asia. The bars on the left-hand side show you the breakdown within the key sectors where those stocks are domiciled. So this does show, say, an HSBC or a Vodafone as a UK company, even though they're clearly global. So it's not exactly replicating what we've got in terms of economic exposure. You can see the three largest sector weights we have in the portfolio. Financials, probably pretty traditional value, not unsurprising given the sort of pressures the sector's seen. But healthcare and infotech, they're in there because we have found stocks that we think are valued in those sectors, even in IT, and notwithstanding the sector's done pretty well. Energy also, the fourth biggest weight, probably pretty traditional value and not too much of a surprise. At the other end, areas like utilities, real estate, consumer staples, which have really benefited from the defensive bid in markets and where we see very little value. Just one chart to show you Europe is really getting better. This is, I think, the most simple one. We've retraced now 3 out of the 5, 60% of the rise we saw in unemployment since the global financial crisis. We've now won back, and we're continuing to see that momentum broaden across Europe. Just a quick snapshot. We do throw this up in front of our investors just to give an indication of what we've got right, what we've got wrong. For us, it's usually the top stocks where we're not putting new money to work, but actually going the other way, whereas the bottom stocks are typically the ones where you'd be thinking that we'd be adding to. Now, having said that, one of those bottom three stocks from last year we've actually exited. That was certainly a mistake. But the other two, I think, indicative, a couple of healthcare names, one which is still in the headlines and still going the wrong way, Teva Pharmaceutical, Gilead as well. But those are the stocks you'd expect us to be looking at and actively adding to the portfolio, just given the extent to which they've lagged. We don't do it blindly. We clearly do make that assessment, but that's more likely to be our regular hunting ground. Why do we think it's still a reasonable time to invest in global equities, notwithstanding that global run? I think this is the easiest indicator. Again, I've gone back to June 2009. It's not the trough in March 2009, but 3 months after that. The average stock in TGG's portfolio is at 1.5 times book, which is basically the same multiple as it was 8.5 years ago. That's notwithstanding that we've got a bunch of tech names in, and of those 3 tech reporters that we mentioned after the close last night, we actually own 2 of them. We don't own Amazon. We can't get comfortable with that valuation, but Google and Microsoft are in the portfolios. But notwithstanding a big healthcare weighting, still only paying 1.5 times book on average for the portfolio, which we think stacks up okay. It has been a tough time for value. Some of our longer-term numbers are clearly impacted by that, as well as being underweight the US, the clearly stronger performing market. But over most timeframes, we're now a touch ahead of index. More recent timeframes, obviously more. 3 years, obviously, still a difficult timeframe. And Wayne made the point about how much the MER, where the MER is. We think that's very competitive versus some of the other global LICs, but it's certainly been something that the board's driven to get down over the last few years. So that'll be less of an impost going forward. That's just some of the key stats. I think Wayne mentioned the critical ones, being the current discount to NTA, the MER, which is now very competitive versus other global LICs. I'd also flag that the board's pretty focused on reducing that discount to NTA further. Pretty substantial number of shares bought back over the last year or so at a pretty substantial discount. So we think that both adds value for shareholders as well as tries to close that discount. And Wayne mentioned a fully franked dividend. There's only twice in its history, which is now 30 years, that TGG hasn't paid a fully franked dividend. So that would certainly be the goal going forward. And it was really a period after the financial crisis. One other thing, and not every LIC pays them, but we do pay LIC capital gains for the last couple of dividends, which basically serves to pass through that discount capital gain as if you were holding the shares directly, which not every LIC is doing.